All right, let's get more on the day's opening calls. To do that, we're joined by James Gerrish from Shaw and Partners and author of Market Matters. James, a very good morning to you. And let's actually start with what we're seeing on markets overnight. 3 straight sessions now of selling in the States in the wake of Jackson Hole. We did manage some gains here locally, but of course today we're looking at further selling here as well.
It was a soft session over in US markets last night, no doubt about it. It was Dow down 300 odd points, and that's filtering into a lower open expected here. It's all in the commodity market, so there was a reasonable sell-off right across the commodity complex, probably with the exception of uranium, which has been remaining strong. So crude oil was the biggest drag over in the US market, and that's feeding into, you look at BHP ADRs, they're going to open down more than 4% lower in our market today.
Yeah, so energy obviously in focus today. Comes, of course, off the back of we saw Woodside with its results yesterday. What did you make of those?
Yeah, I thought it was a very big number for their first half results in terms of Woodside. Profit was in line with expectations, but a big number nonetheless. Obviously higher crude prices have been supporting that. Higher gas prices have been flowing into it as well. It's all about what comes next for the energy companies. So, you've got this push and pull between a lack of new supply coming online, but then you've got these recessionary fears that are gaining traction. So, that's sort of the ebbs and flows in terms of the energy space at the moment, and you're going to see extended, larger amounts of volatility in the space. So, I look at what happened in sort of stocks exposed in coal overnight; they were very weak. Gas related equities were very weak in the US session overnight. So I expect some sell off in the energy companies on our market today, and potentially some of these coal names that have been really strong in recent months.
Would you, though, expect those falls in energy to be short-lived, given obviously we're now looking forward to heading into the Northern Hemisphere winter, and we're seeing that crisis only get worse in Europe?
Yeah, it's obviously this lack of new supply coming on stream into a market that's really tight is pushing prices higher. So, I expect that theme to continue. I don't think there's I don't think that issue will be solved anytime soon. But I'm also a little bit cautious that that's now a consensus trade. So, we're all talking about how tight energy markets are. We're all talking about the really extended prices that are playing out in some pockets of that market. So, I'm a little bit more contrarian in terms of the way we position portfolios, and it does concern me just in the short term that some of these stocks and some of these underlying commodity prices have been super hot for a super extended period of time, and I wouldn't be surprised if some of the hot money starts to leave it.
James, elsewhere in the energy sector, you've mentioned uranium there. Are you liking that sector or not? Because we've seen plenty of false dawns there, haven't we?
Huge amount of volatility in the uranium markets, and I mean this week we're keying off a tweet from Elon Musk, which is saying that nuclear energy shouldn't be taken off stream while Europe's got an energy crisis happening, and I think that is obviously it's probably the most sensible thing he said for quite a while. So, I think that is I think nuclear and the demand for uranium is only going to increase as we transition towards a greater level of renewables and away from the old school power generation underpinned by coal. So I think there's got a big future. I think we're starting to see that play out. I mean, we've got Paladin across our portfolios. We think that's a really key holding in the uranium space. We've also got the Sprott Physical Uranium Trust in an ETF portfolio we manage. So, it's onwards and upwards for uranium at this point in time, Andrew.
James, more broadly, of course, we're at the tail end of reporting season locally. What are some of the hits and misses that you've noticed?
Mm-hmm. There's been a few across our portfolios, more hits than misses, but there has still been a few painful misses as well. I think that the really good results I'd call out would be Altium, cracker in terms of FY22 numbers and the guidance for FY23. Iluka had a really strong set of first half results. I think that's worth calling out. Wesfarmers in the retail space was strong, so their second half was showed a really strong bounce back in particularly the Bunnings business in the second half. So that looked particularly good. On the flip side, I thought, Xero didn't report, but they had AGM, which their commentary around the UK business was weak. Service Stream is probably our weakest holding this reporting season. They outlined an increase in costs, a contraction in margins, even though revenues held up. So I think that's a weak result. And there was the other one I'd call out on the upside is Lavisa, which had a really storming FY22, and they've guided pretty well for FY23.
All right, I think we've just had premium out too, haven't we?
Yeah, we have this morning. So they've delivered revenue of 80 million, EBITDA of 16.6 million. They had guided to a range of 16.5 to 18.5, so they've just scraped into that EBITDA guidance range. So it looks in line. I don't see any guidance they've provided for FY23, but it looks in line for FY22, Andrew.
James, all up, how are you balancing your portfolio at the moment, given what's going on at a macro level, and I guess how that's playing out, particularly as far as equities are concerned?
Yeah, it's pretty tricky at the moment. There's a lot of competing factors at play. The result season we've seen so far has been better, but the guidance has probably been a little bit more cautious and puts more of a red flag for me in the short term. So, we've raised a bit of cash in portfolios. We thought we would have spent that through reporting season as opportunities arose. We haven't. So, portfolios are sitting on somewhere between 12 and 15% cash. We're probably comfortable staying that way in the immediate future. I think the market's probably at risk of going lower after this reporting season. And I think we'll get another opportunity to spend that money and allocate it into stocks that are offering deep value in the next couple of weeks or months.
James, thanks for joining us from Shaw and Partners. Have a good day.
Thanks, Andrew.